Hey, hi everyone. Welcome to another video. And this is a part of option selling adjustments series, which is a new series that we will start from today. A few of the new series we will start, like option selling strategies, positional option selling strategies adjustments. We will start from today, and I also wanted to start something on administration and policy, as well as um, Indian economy and how states budgets run. That series also I'll start in coming few days, and we'll go deeper into the real estate investing series also. Okay, so this is a new series, and today first topic is this is option selling. Okay, so option selling and option selling also, we have gone through option selling both at a positional level as well as at a intraday level. We have went through all the strategies in the backtesting series, and we have seen how those strategies perform both at a positional level as well as an intraday level. And we have even checked the performance of those strategies, like short straddle, short strangle, and jade lizard, reverse jade lizard, as well as calendar spreads, long calendar spreads with calls, as well as long calendar with puts. We have seen call ratio spreads, we have seen put ratio spreads, we have seen Batman strategies also, we have seen. So I've seen non-directional strategies also, we have seen, like bull call spread, bull put spread, bear call spread, bear put spread. Okay, so this is so that's the traditional strategies. You take those traditional strategies to apply to the market based on the market view you have, and we have seen how those strategies perform on certain days, and in certain scenarios. But this is like, you have some option. This is option selling, purely option selling. And in these option selling, when you do a positional option selling, uh, how do you do adjustments? So option sellers, they do some adjustments when they do positional trading. So how they do those option selling trading strategies adjustments, we will go through. And first we will start with short straddle adjustments. Okay, what sort of adjustments can be done to a positional short straddle in Indian index markets? So this is options markets that we are discussing about. And we will go through some scenarios and examples from Nifty, Sensex, and Bank Nifty, and how these adjustments can be done. So what's a short straddle? Short straddle is a strategy where you basically sell a call and put at the same ATM strike price. Okay, the current ATM strike price, you take a call and a put and sell it. That's what a short straddle is. What when your view would be basically that you will expect that market would be a range bound market, and the low volatility will be there in the market. Okay, but when adjustments are needed when the markets become dynamic. Okay, and volatility increases in the market, then you need to make adjustments to the strategy to manage risk and protect profits. Okay, so first thing is short straddle adjustments in Indian index markets, which comprises mainly of Nifty, Sensex, and Bank Nifty. Initial position. So, what is the initial position? Let's say today is Thursday, and we are taking the next weekly expiry, Thursday weekly expiry position. Nifty spot. Let's assume that it's at 22,000, for example. Okay. So, what you do to take a short straddle is you sell 22,000 C, which is a call, and a 22,000 P, which is a put for assume that it's 120 rupees. Okay, so you sell a current spot is 22,000, you sell a call 22,000 C and a 22,000 P, assuming this is just an example, so 120 rupees is assumed here. So you collect a premium of 240 rupees. So that's what is the short strategy. Okay, on Thursday you have taken this position for the next Thursday expiry, weekly expiry. Okay, so adjustments, we will go through different scenarios and examples. So first scenario is delta neutral adjustments. This you need to do when a directional move begins. So you assumed that your initial view was that it's going to be a range bound market and volatility will be less. But okay, so your view was not correct, and there was a directional move which began in the market. Then what you could do is you could do a delta neutral adjustment. So the scenario is market starts trending to one side. Okay, so you have assumed that market will be there within a 150 point or 200 point range, both on the top and the bottom. That's what you assumed, let's suppose. And but what happened is markets started trending on one side, either on the top side, either it's started to go upwards or downwards, and it breaks your short straddle range. Okay, so that's what is a directional move. In that scenario, for example, here he has given an example that Nifty moves from 22,000 to 22,300 quickly. So this is what is a directional move, and it breaks your range basically. Then you need to do a delta neutral adjustment. So what do you do as an adjustment is you convert this short straddle to a strangle, short strangle. Okay, so to do that, what you need to do is whatever position you are losing, you buy back that. So you have you buy back the losing 22,000 CE. Okay, because if market is moving up, then PE will increase in value, but CE will give you loss. So you buy back that you sold that 22,000 CE, right? So you buy back that losing leg, and then you sell a higher C, which is 22,400 or 22,500. You will sell it. You'll keep the 22,000 P as it is, or you can adjust slightly, but you can keep it as it is also. So that is what is the adjustment, which is converting a short straddle to a short strangle, and by buying back the losing leg and moving it higher, basically 22, because the market has moved up. So you'll move it higher. That market will stay below 22,500 or 22,400 when you sell a higher C. Okay, and essentially it becomes a short strangle. And, your view here becomes 22. It will stay above 22,000, and it will stay below 22,500. So that will become a short strangle. Okay. So in this example, 22,000 CE will give you loss, which is 120 rupees. If it has increased to 300, 180 rupees loss you will get. 22,000 PE is now 40, so profit of 80 from 120 to 40. 80 rupees profit you will make, and you'll buy back the 22,000 CE, and you sell 22,400 for 100. Now the in this is the adjustment, delta neutral adjustment, where you're converting a short straddle into a short strangle when a directional move is there. Uh, what's happening is your net cost is getting reduced, and your risk is shifting higher. Okay, so that's the first adjustment you could do. The second adjustment you could do is inversion to iron fly or iron condor. So the scenario here is the first scenario, the directional movement is there in the market, uh, which is contrary to what you assumed that it would be a range bound and a low volatile market. Then you did that, you converted the short straddle to strangle. Here the scenario is you already expect that high momentum will be there after entry. Okay, scenarios could be like VIX is rising, or some news is there, some uncertainty is there in the world geopolitical environment, or RBA policy is there, election is there. So such scenario could be there. So then what you do is you add your wings. Okay, so you take a short straddle, you buy the at the money call and the put, but you add wings to it to hedge yourself. So that wings would be out of the money options you will buy, and then it essentially becomes that short straddle will essentially become either an iron fly or an iron condor. It will become an iron fly when you buy the wings for a short strangle. It will become an iron condor, so it will become an iron fly. Okay, so that's an adjustment. So you will put a straddle, but when you expect that volatility will be high, as well as some news events are there, or movement will be high after entry, then you add the hedge positions. You buy OTM options as hedges, and you will convert it into an iron fly. Example of that is you sell 22,000 CE plus 22,000 PE, so that's a short straddle, but you buy 22,300 CE and 21,700 PE. That's an iron fly. Okay, the maximum risk will be capped, and your margin requirement also drops. So that you will do when you feel like high moment would be there after entry. Then you do rolling the straddle. This is a time decay adjustment. So in this scenario is your position is profitable and you are nearing expiry. So whatever your view was, it's correct that market is range bound, and it stayed with, it was less volatile for that particular week. So you are profitable. Then what you do is once the near expiry comes, you will get the theta, and theta is decaying rapidly. Then you'll close the current straddle and you'll roll forward the same straddle to the next week. Okay, with adjusted strike, or the same strike you could use. So that's what is rolling the straddle, which means time decay adjustment. So initial straddle we collected 240 by selling 22,000 CE and PE, and now at the end of the week it's suppose worth 40 rupees. So you made 200 rupees profit here per lot, per strategy. Okay, then you will roll to the next Thursday. So next expiry, what you will do is again you will sell 22,000 CE and PE for 200 plus. Okay, that's how you keep the theta income flowing. So that's the third adjustment you do when you are correct in your view. You just roll the same straddle to the next week. The fourth scenario is adding hedging legs for gamma protection. So on expiry days, or suddenly there may be a spike due to some uncertain events in the market. So to protect yourself against such uncertain events or black swan events, and gamma protection, you need to add hedging legs to the short straddle. So this scenario is sudden volatility is there due to some geopolitical events like budget, war news, or some Trump feed, or tariffs or something like that, Fed meet, or due to this sudden volatility comes into the market, then a risk of gap down or gap up is there. So in such scenarios, what you'll do is you'll buy cheap OTM hedges, out of the money hedges, like 23,000 C and 21,000 PE. Okay, so 1,000 points above and below, you are buying OTM hedges to protect yourself against gamma blast, basically. So example of this is it Bank Nifty ATM 48,000. You have bought a CE and a PE, so that's a short straddle. But you'll buy 49,500 CE and 46,500 PE as out of the money cheap OTM hedges for 10 rupees and 20 rupees, and this reduces the black swan loss risk for you. Okay. Then the next adjustment is dynamic strike shifting, directional bias adjustment. Okay, so here you have a bias. Okay, so you have a bias that the market will be bullish or bearish. Based on that, you will do an adjustment. Okay, so that is called a directional bias adjustment. Okay, so in the first one, you didn't have a bias, you were neutral, and you thought the market was going to be range bound. Once the market became directional, you made it a short triangle. Here, you already have a bias in your mind. Okay, so based on some technical indicators or higher time frame analysis or whatever, you feel that, or macroeconomic events or company results, industry tailwinds. So you feel that you have some directional bias, and based on that, you do dynamic strike shifting. So scenario is you have a view that the market will trend up slowly, okay, but you want to stay net theta positive. So that is the scenario here. Adjustment you will do is you will shift the strike slowly OTM in favor of the bias. Okay, so that OTM strikes, you will shift the strikes instead of ATM, you will shift that strike slightly OTM in favor of bias. So normal is you take 22,000 CE and PE, right? So that is what is a normal short straddle. Uh, but what you will do when you have a bias is you shift that to 22,100 CE and 22,000 PE, or you will do 22,000 CE or 21,900 PE. Okay, so that's what you will do. That basically slightly bullish or bearish skew you will maintain while maintaining theta income also. So that is a dynamic strike shifting and a directional bias adjustment. Okay. Then we have double entry 2x width for volatility control. So scenario is you are expecting reversion of a faster move. So market has moved up quite a bit, and then you expect the mean reversion to happen, and you want to pyramid. So that's the scenario here. You double enter with 2x width for volatility control. So what you do is you add an additional straddle here at a new price point and keep track of break even levels. So example is initial Nifty 22,000, sell to 22,000 CEP you have done. Market moves to 22,300. Okay, then what you'll do is you'll sell again 22,300 CNP. So two straddles you have taken, 2x width you will get. You will create a zone from 22,000 to 22,300 where profits accumulate. So these are the different adjustments we went through. Okay, we'll go through summarize this particular thing again. So when a trend starts, okay, directional move is there, then you convert that into adjustment. Is you convert that iron short straddle to strangle, and you remove the losing leg. Okay, this protects you from unlimited loss, and Event risk is there, then you add wings, out of the money, wings you will buy and convert it into an iron fly. Lower margin will be there and protects you uh, from that event risk. Near expiry is there, you will roll forward it to the next week. This compounds the theta. Gap risk is there. You buy deep OTM options. That's like an insurance basically, to protect you against gamma blast. You have a directional bias, then you shift the ATM slightly to the OTM. Okay, so this builds delta exposure. And like for example 22,000, you'll shift it to 22,100. Okay, one leg you will push there, bounce back. Market went up and it then it's going to come back, and then you will add a second strategy. So these are all the different range expansion will be there due to this. So these are all the different adjustments for a short straddle. Okay. And yeah, you can use different tools like Sensible, Obstra, Quantsap, and Stock Marker to see how this adjustments work. But this is these are the adjustments, different types of adjustments that we could do for a short straddle based on the scenario that is applicable during that particular market time. Okay, thanks everyone, have a nice day, bye.